Nobody ever sat you down and explained how much of your money the government was going to take. Not in school, not at your first job, not when you started earning online. You just started making money and somewhere along the way realized that a significant chunk of it was disappearing in a direction you had very little control over and even less understanding of. Here is the number that should make you uncomfortable. The average person will pay somewhere between 1/3 and 1/2 of everything they earn in their lifetime in taxes. Income tax, sales tax, capital gains tax, payroll tax, property tax. The list goes on, and most people have never even seen the full picture of what they are actually paying when you add it all up. And here is what makes it even more significant. The people at the top of the wealth ladder are not paying that percentage, not because they are cheating the system, because they understand it. They use legal strategies that are available to anyone willing to learn them. Strategies that the average person either does not know exist or assumes are only for people with accountants and lawyers on retainer. This video is not about avoiding your responsibilities or doing anything illegal. It is about understanding how the tax system actually works, where most people are silently losing thousands of dollars every year without realizing it, and the specific moves that financially intelligent people make to keep more of what they earn. Because building wealth is not just about how much you make. It is about how much you actually keep. Let us start with the most important concept in this entire conversation, because most people have never had it explained clearly. There is a fundamental difference between tax avoidance and tax evasion. Tax evasion is illegal. It means hiding income, falsifying records, deliberately not reporting what you owe. Nobody is talking about that. Tax avoidance is completely legal. It means using the tools, deductions, structures, and strategies that exist within the tax code to reduce the amount you owe. Every strategy in this video falls into that second category. The tax code in almost every country is not a flat, simple system where everyone pays the same percentage. It is a complex set of rules full of incentives, deductions, credits, and structures that reward certain behaviors and penalize others. Investing is rewarded. Owning a business is rewarded. Saving for retirement is rewarded. Simply earning a salary and spending it is the most heavily taxed way to move through the financial system, and it is exactly what most people do their entire lives without ever questioning whether there is a better way. Understanding this is the foundation. The tax code is not designed to take as much as possible from everyone equally. It is designed to take the most from people who do not know how it works. The first place most people silently lose money is through their employment income, and specifically through payroll taxes and income brackets that most employees never fully understand. When you receive a salary, your employer withholds taxes before you ever see the money. Most people accept whatever comes out the other side as the number they have to work with and never investigate whether they could legally reduce what is being withheld. But there are legal ways to reduce your taxable income through employer benefits, retirement contributions, health savings accounts, and flexible spending accounts that most employees either do not use or do not maximize. A retirement contribution in particular is one of the most powerful tax reduction tools available to anyone with employment income. In most countries, money contributed to a qualified retirement account reduces your taxable income dollar for dollar up to a certain limit. That means if you contribute $5,000 to a retirement account, you are taxed as if you earned $5,000 less. You are not losing that money. You are moving it to an account that grows tax advantaged over time. The government is essentially giving you a discount on wealth building, and most people leave it completely unused. The people who understand this maximize every retirement contribution available to them before thinking about anything else. Not because retirement accounts are exciting, because they are one of the few places in the financial system where the government is actively incentivizing you to build wealth and penalizing you for not doing it. The second area where people silently lose enormous amounts of money is through self-employment and online income, and this is the one most relevant to anyone building income streams outside of a traditional job. When you earn money as a freelancer, an affiliate marketer, a digital product seller, a content creator, or any other form of self-employed income, the tax situation changes significantly from employment, and most people do not realize this until they get a bill they were not expecting. As a self-employed person, you are responsible for paying not just income tax but also self-employment tax, which covers the Social Security and Medicare contributions that an employer would normally split with you. Someone who has been earning $1,000 a month from an online business and treating it as pure profit is potentially sitting on a tax liability that will hit them hard when the bill comes due. The solution is not to stop building online income. The solution is to understand the tax obligations from the beginning, set aside the appropriate percentage of every payment you receive, and start learning the deductions that self-employed people are entitled to that employees are not. Business expenses are deductible. A portion of your home if you work from it. Your internet bill. Software subscriptions you use for your business. Equipment. Education and courses directly related to your income. Marketing costs. A portion of your phone. These are legal deductions that reduce your taxable income and that most new online earners either do not know about or are too disorganized to track. The difference between someone who tracks their business expenses carefully and someone who does not can easily be thousands of dollars in taxes every single year. That is money that could be invested, reinvested into the business, or used to build the financial foundation we talked about in previous videos. The third area is investing, and specifically the difference between short-term and long-term capital gains, which is one of the most important concepts in building wealth efficiently. When you sell an investment for a profit, that profit is taxable. But how much tax you pay depends heavily on how long you held that investment before selling. In most tax systems, investments held for less than a year are taxed at your regular income tax rate. Investments held for more than a year are taxed at a significantly lower capital gains rate. This single distinction changes how intelligent investors approach their portfolios. Not necessarily because they make different investment decisions, but because they are thoughtful about timing. Selling an investment 1 week before the 1-year mark and paying your full income tax rate on the profit instead of a much lower long-term rate is a mistake that is entirely avoidable with basic planning. The broader principle here is that the timing of financial decisions matters as much as the decisions themselves from a tax perspective. When you sell something, when you realize income, when you take distributions, these timing decisions can have significant tax implications that most people never consider because they are focused entirely on the transaction itself rather than the tax consequence of it. The fourth thing worth understanding is the power of business structures and why the way your income is structured legally can make an enormous difference in how much of it you keep. Most people who start earning online income do so as individuals, which means every dollar they earn is taxed as personal income at whatever rate applies to their total earnings. But in many countries, structuring that income through a business entity creates legal opportunities to reduce the tax burden through business deductions, more favorable tax treatment of certain income, and the ability to split income in ways that reduce the overall rate. This is not something you can or should figure out on your own without professional guidance, but it is absolutely something worth understanding conceptually, so that when your online income reaches a level where the structure matters, you are not leaving thousands of dollars on the table simply because you never thought to ask the question. The threshold at which structuring your business properly starts making a meaningful financial difference is lower than most people think. Anyone earning consistent online income should have at least one conversation with a tax professional specifically about whether their current structure is optimized. That conversation might cost a few $100s and save several times that every year going forward. Here is the principle that ties all of this together, and it is the one most people never internalize because the financial education system never teaches it. Earning money and keeping money are two completely different skills. Most people are taught to focus entirely on the first one. Get a better job, earn more, build income streams, scale the business, and all of that matters. But someone who earns $100,000 and keeps 70 is further ahead than someone who earns 120 and keeps 65 because they never learned the keeping part. The wealthy do not just earn differently. They structure differently. They track differently. They time their decisions differently. They use every legal tool available to them to make sure that the gap between what they earn and what they actually get to keep and invest is as wide as possible. And they do this not through loopholes available only to the ultra-rich, but through basic financial literacy that is available to anyone willing to learn it. You now understand that retirement contributions reduce your taxable income. You understand that business expenses are deductible. You understand the difference between short and long-term capital gains. You understand that business structures matter. Most people go their entire financial lives without understanding any of that clearly. Here is what I want you to carry with you after this video ends. Every year you spend not understanding how taxes work is a year the system takes more from you than it has to. Not illegally, not unfairly by its own rules, just efficiently, from people who never learned to push back. The money you lose to taxes you did not have to pay is not coming back. But the money you will earn from this point forward can be protected at a level most people never reach, because most people never take the time to understand what they are actually dealing with. You are not just building income, you are building wealth. And wealth is not what you earn. It is what you keep, what you grow, and what you never hand over unnecessarily to a system that rewards the people who understand it and quietly takes everything from the people who do not. Start learning the rules of the game you are already playing, because the game is happening whether you understand it or not.